Right, another good morning to everybody. I wanted to take on a bit further another story that's happened with some client experience over the last week or so, and just share with you some really deep insights we had when looking at portfolio performance. We looked recently about scary times and how the world looks something like this chart, but we can see how it's really dropped on a portfolio, but there are signs of some shoots coming out of the bottom. The last time we spoke about a risk-free portfolio versus the FTSE 100, and this particular graph is a risk 6. Okay, so it's fairly, well, it's higher than a medium, so it's got quite a lot of volatility in there. So I'm just going to show you some really deep insights that we got from that portfolio. I'll take first of all the performance over 1, 3 and 6 months. So 1 month is minus 11.08, 3 months is minus 11.81, and 6 months is minus 8.31. So we can see that the higher minus numbers are very much about the most recent times, and the 6 month figure is lower than the 1 and 3 months. All right. Okay, so we then went into some more detail over 1 month and 3 months, and I've got some colours on here, which is blue for cash and fixed interest, pink for property, and green for equities. And what I'm going to do is just expand on these figures up on our flip chart. Okay. So having a look at the performance of this portfolio, we started with cash and fixed interest. So I've put together those two asset classes of cash and fixed interest and said, okay, well, what was the performance over a 1 month period? So I'm really focusing on a 1 month period for these figures here. Cash, the lowest figure was minus 10.8, and because of the numbers I've looked at the previous week, this is really all to do with the fixed interest area. The maximum performance is plus 1.52, and therefore the range between these two figures is 12.32%. So we then took property as a second asset class, and the figures here are minus 0.3 and plus 0.4, and the range here 0.74, which is, you know, pretty stable, and that's what we would expect from property. The third area is equities. These are the most volatile assets we've looked at. And in this basket, there's UK equities, global, Far East, Europe, America, UK. The lowest performance is minus 26.94, and the highest performance is minus 5. So the range here is 21.63. So really, we've got the biggest range in the equities, which is what we'd expect, and cash and fixed interest as second, and as I say, it's really down to the fixed interest section, not cash, and then property at the lowest range, giving us the most stability. All right, so what I then had as a next conversation was to say, well, let's have a look at the 3-year performance across all of the funds. And what we did was we highlighted the highest performer in 3 years. So we're going to have a look here. So the highest performer in 3 years, which we circled off here, was 66.52. That was a fund called Baillie Gifford Positive Change, and that was that one. The lowest one, again over a 3-year period, is Lazard Emerging Markets, and that's at minus 21.1. So we then looked at the range between these two and that's 87.62. So a phenomenal difference over 3 years compared to a 1 month range here. I then said, well, what are the sectors that these highest and lowest performers have been? And again, it's over a 3-year period, so really they're sticking out like sore thumbs over this period. They're both in the high risk, so we looked at global specialists, so Baillie Gifford is in the global specialist sector, and Lazard Emerging Markets is in the emerging market sector. We then have a scale of risk, 1 to 10, as you all know. And so what number are each of these funds? And they're both on risk 10. So what that then takes us onto is to conclude really about that if you're going to pick the best performer and the highest performance, you're going to end up with a risk 10, or it's highly likely over that period to end up with risk 10. And therefore your volatility on your portfolio is going to be really high. So with most people doing that, you're then going to end up with even greater negativity, like we saw on the FTSE 100 on the last video, than we've got at the moment. Finally, I think just to conclude, we've done a couple of studies which I've shared with some clients over the period, just looking at investment behaviour and how people choose assets and funds. And this goes from 2000 to 2008, and most people will herd and they will follow other people, they will do no risk assessment and no diversification of assets because they're going for those highest performers. Having looked at the performance of a portfolio built in this fashion, it shows that the overall performance back in 2008 was just about 3%, which you could get in cash, and all of the other portfolios are performing better with a lot less risk than picking it yourself. So taking that one forward, I think this is where people are going to be in this decade, having had a big drop in the equity market, which is what we had in the year of 2000, and then people will then go into more safe investments. Yeah, so lessons from today is have a well-diversified portfolio. Make sure you've got different asset classes within there on cash, fixed interest, property and equities to spread the risk and have a much more robust portfolio. Okay, thank you. Bye.